Welcome back to BLOCKTV. It's time now for Hodl with Hedl, a chance to zoom out for a moment and take a wider perspective on some of the heady issues that dominate the Bitcoin markets as a whole. And to guide us on this journey of discovery, we're joined by Bitcoin influencer and thought leader Dan Held, co-founder of asset management firm Interchange. Dan, thanks for joining us.
Thanks for having me. I first want to start out this segment, which is going to be a weekly segment, with thanking my fans and thanking my followers for helping me come up with the name. Hodl with Hedl was one of the couple names that my followers came up with as a good name for this segment, and I'm super psyched that we could name it this.
Yeah, certainly, I think it's a great one, and it'll be great to see how it continues into the future. All right, so Dan, kicking things off, we want to talk about Bitcoin as a store of value. And I just want to start off by just asking the sort of question that gets thrown around a lot when it comes to Bitcoin, is that how can Bitcoin manage to be a store of value when it's not uncommon for price movements of 20% or even more in a single month?
That's a great question. And intuitively, you would feel that a store of value should not fluctuate. However, if we look at the oldest store of value that humankind has used, which is gold, gold is not stable, not something that we would consider stable. It actually fluctuates quite a bit. So a money, the properties that it has as a store of value aren't necessarily around price stability, since that is a lever that the money itself can't control unless it's controlled by a government, which doesn't make it a good sound money.
So, I mean, looking at gold's comparison, I mean, certainly you are right. Back in the 1970s, after it was separated from the then fiat currency, destaked from the US dollar, we did see massive fluctuations in gold. Certainly in 1974, gold bullion rose 73% and fell 24% in 1975. So we do have that historic comparison, but it did eventually obviously settle into more of a less volatile pattern, into the sort of gold as we know it today that moves as a steady, secure store of value in that sort of modernized sense of our understanding. Do you think Bitcoin is headed for the same sort of path?
Yeah, another great question. It's something that I think when we look at Bitcoin's trajectory over the next few decades, if Bitcoin continues to succeed and its market cap grows and the volume grows, and the depth of the order book grows, I think we'll see the price slowly begin to become less volatile. But to be clear, volatility I don't think is a bad thing. If Bitcoin had stayed at $10 and had been stable at $10, none of us would be here today to talk about it. With each wave, each speculative wave, each wave brought in a new cohort of adherents or believers or hodlers who decided to buy Bitcoin and give it more and more value. And the number of hodlers grew with each wave. In addition to the hodlers, there was new waves of developers, both on the core protocol and on applications. And we see Satoshi kind of think about this way back in the original, 2009, 2010, when he talked about this on the Bitcoin Talk forums. He talks about how speculation will likely drive awareness and adoption. And so my fun kind of, I'm extrapolating a little bit, but I think Satoshi programmed in the halvening events every 4 years to create a supply shock, which then would create a speculative bubble versus a smooth supply curve. Satoshi, other engineers likely would have engineered a smooth supply curve, but Satoshi decided that every 4 years, the amount of new coins being issued per block should drop in half. What happens then is that there is the same demand chasing less supply that's hitting the market on a daily basis, because Bitcoin miners are forced sellers due to their real life costs of the machinery, the ASICs, and the electricity, that the halvening events actually might cause speculative bubbles, which has exponentially increased Bitcoin's awareness, liquidity, and market cap. So I think volatility is a good thing.
I mean, certainly it can be perceived as a good thing, and as it stands, if we're looking at Bitcoin as today, as of the time of recording, a total market cap of around $139 billion. But in order to become that true store of value that we're talking about, if we try and make comparisons to, say, gold, which has a global market cap in the realm of about $7.5 trillion, orders of magnitude above where Bitcoin stand. I mean, is that where you think Bitcoin is inevitably headed in terms of, I mean, the highest estimates put it as a replacement store of value for gold, or do you think it will settle somewhere in the mid area, or how does a store of value translate into direct sort of market cap wealth available within the Bitcoin sphere?
Yeah, so we can look at a couple different asset classes and use those as a good equivalent of the market capitalization that Bitcoin might hit if Bitcoin starts to absorb the store of value use case from other assets. So gold, like you said, is at 7.5 trillion. That is certainly one asset type that Bitcoin could start to eat away or chip away at. In addition to that, we could look at traditional fiat monies that are used as a store of value. We could look at real estate, which is a $250 trillion market. There are large swaths of San Francisco, where I live, and in New York and London, where people solely buy property just to store value in that property, which, by the way, is a huge net waste for society, as that property then can't be used for its original utility, which is to house people. Instead, it's being used also as a store of value, and that's caused significant social strife in those cities, especially San Francisco, where we have a housing crisis. But Bitcoin could chip away at those other assets as well, including, I mean, if we look at sovereign debt, we've got, I think at the last time I checked, it was negative. There was $10 trillion of sovereign debt that was trading with a negative yield. That's pretty insane. And sovereign debt is often used to park wealth. So I think that if we look at how much Bitcoin could chip away at the entire world in terms of other store of values, I think gold is the lower bound estimate of what Bitcoin might become over many, many, many decades. Money is a belief system, and it takes a long time for everyone's shared belief over what money is, especially in the new form of a digital one that's not controlled by anyone, which is Bitcoin, to kind of permeate the consciousness of the world.
Certainly an optimistic outlook, but I want to turn to one of the key points you raised just there, talking about utility, because of course Bitcoin is not entirely intended to be served just as a store of value, but also as a means of exchange. And that's something where perhaps Bitcoin has struggled to live up to some of its expectations, or certainly the initial expectations of Satoshi Nakamoto in his white paper, at least so far in its life cycle. Do you think this is going to change, or are we looking to exchange one for the other in terms of store of value versus means of exchange?
Yeah, so I don't think they're necessarily mutually exclusive. Over a long time horizon, I think Bitcoin's initial protocol market fit, which is a kind of funny pun on product market fit, its protocol market fit over time, I think, will also be medium of exchange and unit of account once that volatility subsides. Volatility for everyday coffee payments and marking, if you went to the grocery store and every single item was marked in Satoshis, as much as that makes me super excited because I'm a huge Bitcoiner, it's just not very practical for the common consumer. And I think we always need to think about how they would react to certain products or certain things that we work on around Bitcoin, because I think a lot of us get a little too excited and we want everything to be priced in Satoshis and everyone to pay for everything through Bitcoin. But if it's more volatile, they have to buy it on an exchange, which has slippage costs, and they have to pay a transaction fee. We can easily see that Bitcoin being used for coffee payments doesn't really make a lot of sense at this stage. They're not mutually exclusive. It just doesn't make as much sense at this stage versus later down the road when its volatility subsides and more people believe in it. Let's say, 200 million or 1 billion people own Bitcoin. That's a much different sort of scenario.
But using the comparisons, I suppose, that you mentioned before, whether it be gold itself, the real estate market, whatever it might be, those store of value asset classes obviously aren't used as a means of exchange as well. Do you think that Bitcoin can retain its value into the long term as a store of value, but also functionally be used as a means of exchange? Or do you think there will be required to be additional layers put on top of the system or possible alternatives in order to make that functional?
Yeah, so to be clear, with medium of exchange like Bitcoin as a store of value asset still has to move money around. But I would argue that those items should be like more large investment style transactions where it's it's part of your savings, right? Versus a $5 cup of coffee. So to be clear, when I mean medium of exchange, that's by default enabled through a store of value type asset where you have to transfer to someone else. We're talking about the small medium of exchange sort of use cases, the retail or transactional use cases for merchant processing. So to be clear, that's kind of what I'm referring to here. While Lightning, so layer 1 transaction fees are based on bytes in terms of data size. That's really great for large transaction sizes because you can send $1 billion for 5 cents, and that's incredible. And so there's a natural trade-off between layer 1 transaction fees, which are based in bytes, and layer 2 technology like Lightning, where the transaction fees are based in the value being sent. And so there's going to be a natural trade-off between the two as Lightning becomes more and more popular. So I think we'll see technologies like Lightning greatly improve the user experience of Bitcoin around speed or perceived speed and transaction fees. However, Lightning does not solve volatility, and that still, I think, is very tough for consumers to wrap their head around.
Certainly, it is still a bit of a way before it's actually accessible to your common, I suppose, unsophisticated consumer. But I want to switch tacks a little bit and now talk about the second topic that we wanted to cover here today, that of Bitcoin's security model. And I want to specifically open up this start of the conversation by asking, I think, a very important question, which is, so at the moment, as it stands, there is a concentration of mining pools when it comes to Bitcoin in the Chinese market. By some standards, over 70% of Bitcoin's collective hash rate belongs to Chinese miners. Do you think that there is a risk there of damaging the integrity of the Bitcoin blockchain or of the security of Bitcoin as a whole by the fact that there is such a concentration of mining pools in one nation?
Yeah, I think that's a common concern, which is does China have an overdue influence or an overbearing influence on Bitcoin? So miners, by the way, are merely security guards for the network that we pay. So miners purchase equipment, CapEx, and they spend CapEx on the ASICs and OpEx on the electricity to secure Bitcoin's network through burning energy, creating that thermodynamic guarantee that your payment can't be reversed. Because of that, miners act in a fashion that is very capitalistic. They want to recoup that initial sunk cost. Starting at the top, we don't know how many miners are in China because miners can operate behind Tor and miners join mining pools. So when we look at mining pool concentration, we don't necessarily see a majority of them being in China, and those change constantly. With the physical ASICs themselves, yes, it's likely a good chunk of them are in China due to the very cheap electricity costs. Over time, I think we'll see this be more and more dispersed. So I don't necessarily see it. Also, A, I don't necessarily see it as a problem. B, we don't know if it's a problem or not. And C, it's going to become less of a problem in the future.
All right, so as more and more get involved, perhaps we can start to disperse some of these issues. So bring it then back down to the sort of individual consumer when it comes to security. There's a bit of an ongoing issue right now with Bitcoin security when it comes to the unsophisticated consumer, but even to the sophisticated. And we've seen this, for example, in the case of the Quadriga CX exchange, where it went down because people didn't have access to the private keys. You lose, someone unfortunately dies or misplaces a key or loses their private key, and we have this bottleneck effect where the security mechanisms of Bitcoin, as strong as they are, risk sort of cutting people out from their own money, their own finances, without an insurance policy to fall back on and behind that. Is this not an inherent problem in the security protocols that lie within the system, and is it one that can be resolved?
Yeah, so I'm going to say something a little bit controversial. Most old Bitcoiners won't necessarily agree with me, but I think consumers should evaluate both custodial and non-custodial solutions, not just non-custodial. A lot of Bitcoiners say not your keys, not your coins, and they're 100% correct. However, I'm not sure if I'm going to trust my grandma with her private keys. I would rather her rely on a trusted third party, because the likelihood of that trusted third party trying to steal her money is less than her losing her keys. So that's sort of the mental equation, right? If you're not very comfortable with this, then you could very much lose all your money, which kind of makes the whole, not your keys, not your coins, a little bit pointless if you don't have any money left. So I think right now you don't necessarily have to decide between one or the other. You can maybe do a combination of both, depending on how sophisticated you are. And of course, using best-in-class techniques like non-SMS 2FA, and using, an auto-generated 30-character password. Those will help a lot. And then in the future, I see multi-sig being a really, really good trade-off between the two, where multi-sig is also you holding some of your keys and then not trusting everyone else to hold the rest of your keys. You just have to trust that everyone doesn't collude together. And I think that will be like a really elegant solution to this problem in the future.
And you think it can get to the point where even the institutional investor, the unsophisticated investor, can work sort of seamlessly in the background for the wealth of different potential investors and speculators within the entire community and market?
Yeah, I think this could work for both the institutional and the retail trading side or the common consumer. With multi-sig, there's much more forgiveness around the user experience around managing those keys. So in the future, you might hand one to your dad or your brother, your CPA, your attorney, the technology company that hosts your wallet, and then you hold one on like your phone. So there's a lot of different ways to architect it. I just went through thinking through that myself with I signed up with Casa's Gold program. In Casa, with the Gold program, you get your full node, and then they help you get set up with multi-sig. And so thinking through the different key holders was kind of a critical part of that discovery process for me of thinking through, well, how would I've always managed my own private key, but then I manage it across multiple different stakeholders. And so that was kind of an interesting mental exercise. And I think we'll see a lot of good solutions come out of this. I see it as a very linear problem to solve. I think we'll see a lot of solutions over the next couple of years.
Now, speaking of solutions and of future problems, I'm going to use this space here now to take a bit of a leap into the future and take a look at some potential issues affecting this market in the long term, because as we've all pointed out, and as well I think we all like to believe here, we look at Bitcoin into the long term as the potential for future capabilities that it has. I want to talk a little bit about the potential risks of quantum computing and how that may risk the security protocols that exist within Bitcoin. Now, it's been speculated that because of the nature of the cryptographic protocols of Bitcoin, a quantum computer, not so far off into the future anymore, so it seems, so those in the field will tell you, could risk committing a 51% attack and actually be an existential threat to the Bitcoin network as a whole, the blockchain as a whole. Do you think this is something that is realistically problematic to the future integrity of Bitcoin as a whole?
Yeah, I think there's a lot of concerns around how quantum computing will impact Bitcoin in the future. I missed a talk, so I was just speaking at the Visions of Bitcoin conference in Munich, which was with the Federal Reserve, the German Central Bank, and a German investment bank, Bayern LN, in Munich. My talk wasn't on that, but I did miss a talk that was on how quantum computing might impact Bitcoin's protocol, and it came from a quantum physicist. I think the TLDR was that it's not as big of an issue as people like to bring up. I think a lot of people look at it as like, oh, everything can be cracked. But by very, very limited understanding is that quantum computing is very good at a very small set of things. And some people have hypothesized that like breaking encryption might be some of that. So from what I've heard, it's actually not going to be that big of a deal. If it is a big deal, then we can implement quantum resistance into the protocol. And then finally, Bitcoin's value isn't just in, oh, if someone cracks it, then it's over. This is a social network, and we all have stored our time and energy, which is money, into Bitcoin's ledger. And if there was a critical flaw where all of a sudden there was more than 21 million Bitcoins printed, or all of a sudden all of our the whole system was essentially, there's some issues with the core protocol, it would be hard for me to believe that Bitcoin would just die. I think we would fork it and then implement those features that would bring about the same rules that we agreed with to begin with, which is like the 21 million hard cap.
So then, I've thrown a couple of specific scenarios at you so far, and you overall seem pretty optimistic about the future of Bitcoin. Are there any things that keep you up at night, any potential security threats within the Bitcoin network that you see as potentially endemic, whether in the near, medium, or long-term future?
Yeah, the piece is called Hodl with Hedl, so it's going to be a little bullish on Bitcoin.
Of course. No, but certainly I
But,
just wonder if there are any issues out there that you think could be problematic. Maybe not to the point of existential threat to the entire blockchain, tearing it down, but some endemic security issues, or do you think it's all a tight ship?
Yeah, I think there's a few. One would be if all the governments went back to the gold standard. I think that might set Bitcoin back for decades. Gold is a much older narrative, a much older meme than Bitcoin, and is much more understandable. So they could significantly damage Bitcoin's trajectory if they did that. So I would say that would be a kind of a threat or attack vector. And then, like I mentioned before, Bitcoin is a social network. So any attack vector that would divide the hodlers into two different camps, let's say privacy becomes a really important issue and that divides the community quite a bit. If that divides the community and we decide to hard fork again, and the community splits in a fashion that is more like 60-40, I think that would be very damaging and potentially deadly for Bitcoin. We were lucky during the Bitcoin Cash hard fork that only a very small minority actually really believed in the new fork. And so because of that, Bitcoin's core community and that the entire social network was well preserved, even though it lost a little bit of it. But like I said, if it was a more divided fraction like 60-40, where there was a hard fork and the minority fork had 40% of the market cap of the major one, and it held that consistently, then I think we'd be in a really, really bad spot. So I think social attack vectors are big. In addition as well, NSA or other intelligence agencies could pressure core contributors to insert code that has a flaw, and they could use that to essentially undermine or exploit the protocol. Hopefully in the future, over the next few decades, as Bitcoin gains more and more prominence, we update the core underlying layer 1 tech less and less, which reduces the attack surface area for inserting a bug of that type.
All right, certainly be interesting to see what the future holds and how the industry manages to hold out. I want to thank you, Dan Held, for helping us hodl with Hedl and understand a little bit more of these bigger issues that really fulfill the needs and desires of the Bitcoin community and the blockchain industry as a whole. Dan, thanks so much for joining us here on BLOCKTV. And of course, stay with BLOCKTV at our website at blocktv.com. I'm Asher Westrop Evans. Thanks for watching.
For more news and updates, follow us on Twitter